My name is David Call with Ryan Everett Insurance. What I'm going to show you today is a way to decide what deductible are you going to choose for your insurance. That's done using the break-even point analysis. So let me go in and show you how that works. So let's say you're facing the choice on your car insurance. What deductible am I going to choose? Do I want to have the $500 deductible on my car or a $1,000 deductible on my comprehensive and collision coverage? Well, it depends on how much you can save. So here's an example. Let's say your annual premium is $1,200 a year when you're paying a $500 deductible. This is assuming you even have a claim. Or let's say you have a $1,000 deductible and the premium is lower. So that's good. What we need to do is figure out what is the probability of me even having a claim, and let's see what the math shows us. The math is very telling. It's not always 100% accurate because we're trying to guess what the probability of the claim is going to be. So let's start with this. Let's say what we're trying to say here is for a $500 higher deductible, I can save $250 a year. So $500 higher deductible, and that gives me the savings of $250 a year. That's a 2-year break-even point. So what we're trying to say is, in this case, if historically I go longer than 2 years in between claims, maybe I don't have a claim but every 15 years, then that's a pretty short break-even point. That means after 2 years, it's all gravy. Even if you do have a claim, you're saving $500 a year, or I'm sorry, $250 a year. So over a period of 7 years, now that's compounded to quite a bit of money. Or say over 10 years, now we're looking at quite a bit of savings in your pocket. My whole strategy with my clients is to help them build their wealth. One of the only ways to do that is to keep more money in your pocket and not paying that money to the insurance company. Whenever you choose a higher deductible, you're always going to have a lower premium, which means you will have more cash in your pocket. When you have more cash in your pocket, you can afford to pay a higher deductible if and when a claim actually occurs. Let's say it was a home insurance deductible choice you had to make. On a $500,000 home policy where the coverage is $500,000, let's say that you could choose a 2% deductible or a 3% deductible, and the difference in the premiums are here. So that's a $500 difference in exchange for a $5,000 higher deductible. So again, the break-even point would be, let's take $5,000 in extra deductible divided by our savings per year, which is $500. That's a 10-year break-even point. So if we say we're living in North Texas where hailstorms happen about every 7 years, maybe you don't need to take that risk. Let's say the savings was different and the numbers were different. Let's say that this was $1,000 a year and that now is a 5-year break-even point. Well, then you're like, well, there's a good chance my roof could last longer than 5 years, so I'm willing to take that chance. This whole break-even point is the way I help clients make their decisions, because our goal is to help you make an informed decision that works best for you.